Welcome back to Success with Steven. My name is Steven Smith. On this channel, we talk about all things financial literacy. And today, I'm going to talk about how to pay off your maxed out credit cards when you have zero cash flow. And yes, it is possible. So if you're about to start missing payments or you plan on letting a credit card account be charged off because you think the debt is just too astronomical that it can't be paid, then this is going to be the video for you. And hopefully you'll find a lot of value in this information. So I have a lot of videos on credit repair, but it occurred to me that, sometimes prevention is better than the cure. So before you let those accounts go, I do want to present this to you as an alternative. This will allow you to pay your credit cards, even if you have zero extra cash flow, no extra money. And what I mean by that is if your income and your expenses are at a deadlock, you'll still be able to pay down your credit card using this method. Now, for this method, we're going to be using something that you may or may not have heard of, but it's called velocity banking. Now, velocity banking is a strategy that I've heard about forever ago, but it's essentially a strategy where you use a line of credit, like a HELOC loan, something that has a very low interest rate because usually the amount is so large, and you use that to pay lump sums off of a loan. And the idea behind it is that using this line of credit will help you use your cash flow and extra money to cover expenses with higher interest rates. But this is not what we're going to be doing. But the principle, in my opinion, is the same. So I just wanted to make note of that. Now, the main issue with velocity banking is that it's a strategy that uses debt to pay down debt. And I think that the strategy stems from a misunderstanding of the infinite banking concept, which is best used with whole life insurance. But that's a different topic. So we're not going to get into that. But this strategy, in order for you to do it, what I really want to get you to understand is that it does take a lot of discipline on your part, and it may not be for everyone. However, I do believe everyone is capable of doing this in order to pay down their credit cards. For this example, we're going to be using the most realistic statistics that I could possibly use. Now, the average American makes around $60,000 per year. These are statistics that you can find yourself online. You can check them. If this does not apply to you, then, fine, you'll have to adjust it to whatever it is that your income is. However, this is the average. So in theory, it applies to most people. It's not all people, but it should apply to a majority of you across the board. All right. So this example will represent someone that makes $60,000 per year. That can be represented as $5,000 per month, but they also spend $5,000 per month, which leaves them with zero cash flow. So that should be easily understood. So they really can't pay off any debt if they're spending exactly the same amount that they're making. So we're also going to include rent or mortgage in this example because we want to make it as realistic as possible. And we're going to have a credit card with a $20,000 balance that is maxed out. On this $20,000 credit card, the minimum payment is $800 with an interest rate of 17.99%. A credit card minimum payment is usually calculated as a flat percentage of your total balance, although some credit card issuers may add new interest, fees, and other past due amounts to your minimum payment. To find out how your minimum payment is calculated, check your credit card's terms and conditions. So for example, if you have something like a Capital One Quicksilver Cash Rewards credit card, your minimum payment for balances over $25 will either be $25 or only 1% of your balance, whichever is greater, plus any new interest, late fees, or any past due amounts. Not all credit card issuers include credit card minimum payment calculators in their list of rates and terms. So if you're not sure about your credit card's minimum payment or how it's calculated, contact your credit card issuer and ask, how much will my minimum credit card payment be? For this example, I'm using 4%. So 4% of $20,000 is $800. So now that we know the scenario, what do we do next? Let's move on. So step one, we're going to find every bill that can be paid on a credit card, and we are going to separate those bills from the bills that cannot be paid on a credit card. In almost every scenario, besides rent, Any other expense should be able to go on your credit card. And I'm not talking about plastic or using any type of alternative method to pay your rent or your mortgage on your credit card. We're not talking about that. We're just talking about what really can be paid without doing anything additional. So once again, in this example, you make $5,000 per month, you have zero cash flow, and the rent is $2,000. All right. So if our rent is $2,000, our expenses that we have left, it'll be $3,000. So first thing that we're going to do is deduct all the money that cannot be spent on a credit card. We're going to put that in a separate account. All right. Rent or mortgages usually fall into this realm. So if we have to pay $2,000 for rent, that will leave us with $3,000 for all other expenses, food, gas, etc. It's going to be covered with this $3,000. The second thing that we must do is we're going to take every dime that we have left and we're going to put that amount on our credit card. So now we pay this $3,000 and we have to make sure that we do one thing that's crucial to this strategy in order for it to work. You have to pay this $3,000 on your due date, and you don't want to use it until your statement cycle date closes. For most of you, your statement cycle date should close 3 days after your due date. I'm going to give you a really simple example. If your due date is the 15th of every month, that means that your closing cycle date is on the 18th, 3 days later. On the 19th of the month, you're going to have a new statement cycle date. That is when you would want to actually use your card. All right. I have an entire video on statement cycles if you want to check that out. The point is, what you want to do is make sure that when you pay this down, your new balance is $17,000. When the statement cycle closes, this is what gets reported to the credit bureaus. This is what gets reported to the bank. You do not want to run your card up with any bills until that cycle date closes. So for those few days, you want to pay the $3,000 and do not use that card. And I'll explain in a minute why. Not only will this help increase your credit score, right? Because what you're going to be doing is paying this card down. Your utilization will actually look very good when the statement cycle date closes, because that's a snapshot of what the credit bureau see. They're just going to see a balance of $17,000 no matter how much you spend afterwards. All right. So by reducing the utilization, that's going to help our credit score. We're also going to see a $2,200 expense because we're going to spend $2,200. And yes, I said $2,200, not $3,000. I'll explain. All right. Let's continue. So here's the breakdown. You have a $20,000 credit card line that's maxed out. You have a minimum payment of $800. You have a 17.99% interest rate. The minimum payment of $800 was paid on the due date. We did not use our credit card for at least 3 days or so. And then what got reported to the credit bureaus, what got reported to the bank, is that we have $17,000 on this card. Now, that means that we still have $2,200 left to actually spend. That little cushion right there, that $800, that looks like cash flow now. Let me explain a little bit more. So once you move this money to the credit card, this will cover the $800 minimum monthly payment. We've satisfied that payment once we did that, essentially eliminating this as a monthly bill. Remember, credit cards work in cycles, so we're always paying the previous month. So when you put that $800 additional onto this card and we let the statement cycle date close, it appeared as if we paid an extra $800 towards the principal, because we let the $17,000 go into a new statement cycle and get reported, right? We just created an $800 cash flow where there was zero before. So each month that we continue to make these payments, we will start to actually see the principal go down. All right. Let me continue with another breakdown to help further explain this. Now let's talk about our month one. We're paying $3,000 towards $20,000. That leaves us with $17,000. All right. We're going to add $2,200 onto there because that's the rest of our expenses. Remember, our minimum payment was always built in. That $800 was always built in. So now we have $2,200 that we're going to be spending for our regular expenditures throughout the month. We will have an interest rate of $294. That's what we're going to be paying on our balance. That means that the new balance on our card after we spend the $2,200 is $19,494. All right. So now we've essentially paid $506 towards our principal. Even though we have an interest that we still have to pay, we are slowly chipping away at the principal. Hopefully that makes sense. Let's continue. In this example, because I do know that some people are very pessimistic. I get it. It's natural for humans to always look at the worst possible outcome. So even if you have a credit card, in this new example, I bumped the interest up to 30.99% interest rate. I just wanted for anyone that has the, well, what if it's this or it's that? I don't know of any credit card that has a 30.99% interest rate. And if there is one, it's probably very few. And if they are, they probably don't have a $20,000 limit. So chances are this won't apply to anyone, but I want to use the most extreme example for anybody who just, the most pessimistic person here. So even if you had a 30.99% interest rate, which you probably would not, that would be $418.20. Your new balance would still be $19,628.20. You would have still paid down $381.80, even with this unrealistic interest rate. All right. And yes, it's a very small amount, but I'm going to show you what happens when we chip away at this. And I'm going to give you an additional strategy to help get the remaining balance down and help you start saving money. Let's talk about the interest really quick. I just want to talk about how you calculate interest. So how do you calculate your daily APR? Now, your credit card company may calculate your interest with a daily periodic rate. I've worked in 2 banks. They use the same exact thing. This is how you calculate your daily APR in 3 steps. You find your current APR and current balance in your credit card statement. You could pull that up online, pull it up on your phone. You should see it. You want to divide your APR rate by 365 for the 365 days that are in a year. You're going to do this to find your daily periodic rate. You want to then multiply your current balance by your daily periodic rate. And I'm going to use an example from what we just saw. So if your current balance is $17,000 now for the entire month and your APR rate is 17.99%, you can find your daily periodic rate by dividing your current APR by 365. So if you take 17.99% and you divide that by 365, you will be at approximately 0.0492%. Now here's what you do next. You're going to multiply 17,000 by 0.00049. You'll find that your daily periodic rate is $8.33. Now, in order for you to calculate your monthly interest charges to your balance, you simply need to multiply this daily periodic rate by the number of days in your billing cycle. Some people only have 28 days. Let's use 30 for this one. So if you have a 30-day billing cycle, then you're going to take $8.33 times 30. That's going to be $249.99. For most credit cards, the average billing cycle date is going to be about 30 days. And for some, it'll be 28. Now, the last interest rate you would have had would have been $9.80. Multiply that times 30, it's $294. You're already saving $44.01 on interest. I'm really hoping that you're understanding and you're seeing that how chipping away at this not only chips at the principal, but it starts to knock down the interest. And I hope you also understand how you can calculate your daily interest to understand how much that you're going to be paying. Let's move on. Now let's take a look at month 2. At month 2, you're at $19,494. We're going to deduct $3,000 because we're going to pay that. This satisfies the $800 minimum payment. That now leaves us with $16,494. And remember, we're going to make sure we don't use our credit card until the statement cycle date closes. And then what happens? $16,494 is what will get reported to the credit bureaus and to the bank. Okay, so now we're going to spend our other $2,200, plus we're going to have an interest of $242. The new balance is now $18,936. We've essentially paid down $1,064. Now, we're going to keep doing this over and over again. I hope that this is making sense to you. But every time that we pay that $3,000 and we let it get captured, this is the balance that they're now seeing. This is effectively creating cash flow where cash flow never existed. Now, let's say that we just kept doing this and kept chipping away at it month after month after month after month. Here's month 3. Here's where we're at. We've essentially paid down $1,630. Let's chip at it some more. This is month 4, $2,205. And we just continue chipping away at it. And we continue just chipping away at it. This is month 6. All right. I mean, it just keeps going and going and going and going. Now, I did some calculations where I tried to do it fairly quickly, so this may not be approximate, so please excuse me. Again, this is an example, but it should be fairly close. Now we're looking at month 7 through month 18. We just kept chipping away and chipping away and chipping away and chipping away. Keep in mind, we never added any more cash flow. We're not working any extra hours. We're not adding any extra money. We're not doing anything. We're really just manipulating the cash flow based on the statement cycle close date and what we're paying at that time, what gets reported. We continue doing this, and continue doing this. It will chip away at the principal slowly but surely. So I kept going for various months. And if we keep going at this same rate, somewhere around month 27, you will have paid down everything to essentially 30%. Now, why am I stopping at 30%? 30% is very important because that's where the utilization for at least the credit bureaus starts to look pretty good. It starts to look really good. Your credit score at this point probably has gone up quite a bit. You've probably noticed that your credit score is fairly decent. So at this point, 30% of $20,000 is $6,000. You should be right around there for your balance. Now, here's what I recommend, and this is where things get good, and this is where you can actually start saving money and getting ahead. All right, so if you have a $6,000 balance, at this point, you're at 30% or less. At this point, I recommend that you look at a balance transfer. Now, a balance transfer is something that you do when you have a large amount and you move it to a new credit card. When you move it to that new credit card, normally it has a 0% APR introductory offer. So how we were paying that $294, $200, whatever, how you were paying that amount, it's gone now. We've moved that balance over to a 0% APR card. And essentially we went ahead and we were able to do that by chipping away at the principal. So now that we have a 0% APR balance transfer card, you can play with this how you want. Here's my recommendation. If I have no APR, I could essentially pay off the remaining balance on this credit card just by paying $1,000 a month. I could pay it off in 6 months. Most typical APR 0% offers are for a year at least. So you can now pay $1,000. And guess what that does? That is going to free up a good amount of money for you. So if you're tightened up and you've been very disciplined at this point, not only will you get back that $2,200, you can start setting aside about $1,200 a month and start saving it. That is really amazing. So transferring your balance from a high interest, usually there is a transfer fee. The fee can range from 3 to 5%. So for example, if you're transferring a balance of $5,000, then it could cost you $150 to $250. But I believe that it's worth it in the end. Now, I have a video where I talk about budgeting and how I was able to save $15,000 within a short year with a very, very low income. I'm going to put that calculator in the description because at this time, when this happens, this is when I think you should start setting aside money, and you should start using a combination of this budgeting system and a high yield savings account to not only save money, but also grow it. I'm going to show you exactly what that calculator looks like. All right, so when you get the calculator pulled up, it's going to look like this. When you first use it, follow the directions at the top. It tells you this is a view only file. It cannot be edited. So you need to create your own copy. Simply go to file at the top, and then you're going to go to make a copy, and then you're going to make a copy. That is it. Very, very simple. Once you have a copy of yours, then you'll be able to edit it. And it's a very simple calculator where you could put in your salary and your wage, and you could add all of your expenses here. When you add all of your expenses, there's a section for your mortgage, your electricity, your gas, your car payment, your auto insurance, your fuel, your groceries. And then if you want to add more, like let's say you want to add like childcare and that cost you $500, you enter that in. And as you can see, the total expense is updated. So before it was around 42,000, now it's 48,000 for this new expense. It has your total right here, how much you expect to spend in the actual year, and then it tells you right here how much you can save. So right here, because I added that new expense, it shows me I can save $9,000 extra per month based on my expenses. But if I go ahead and take this out and hit enter, I can save $15,000. Transfer to savings after 1 year, $15,000. That's what you're saving per month. Again, I suggest that you check this out. I also have a video that talks about the budgeting. I would use that in combination with this, because if you put it into a high yield savings account, you will also earn some interest on your money, where your money can appreciate while you're saving. This is really everything. By the time you get to that 30% less, you're going to start seeing your credit score rise exponentially. You're also going to see that it's very easy for you to start to free up money at that point. And with those new habits that you've actually grown by having to do this for so long, it's going to be very easy for you to set money aside and then finally get ahead. Hopefully start to realize that you can invest that money, or you also increase your income at that point, and then you're able to actually grow that money at a much faster rate to where this won't be a problem anymore. So again, thank you guys so much for watching. If you found this information helpful, please, please, please like, comment, and subscribe. Share this information with anyone that might need it. And also use that budget calculator. Check that out. I spent a lot of time on that, made that a few months ago. I really want to make sure that that tool gets utilized and it can help people. So please, by all means, download that tool and use it however you see fit. All right. Thank you so much for watching. You guys have a wonderful day.